Testing 1, 2, 3. Alright, looks good. Alright, ready to go. Let's do it. We are not going to count down again. Let's see. Let's see, what is this? There we go. Obviously, I don't have things perfected yet. How you doing, friends? This is Season 3, Episode 2 of the Final Hour Show. And I'm Coach Ernie. And today we are going to talk about, as I promised yesterday, about how volatility affects options. This is going to be a really impactful show. I would suggest that you bookmark this show so that you can go back to it and watch it over and over and over again. Because I'm going to show you some things that even people that I have coached that have had professional traders, I'm talking about people that were institutional traders or trading at a prop firm that have joined my firm, and I've taught them things that they didn't even know after trading for 20, 30 years. So what you're going to learn today is going to be incredibly powerful and important to your options trading. And what it's all about, what we're going to talk about is the effect that volatility has on premium decay. And that's about as important as a topic as you can possibly imagine if you're going to be trading 0 DTE, considering that everything that we do, or almost everything that we do, is centered around collecting premium. Now, of course, we do both collecting premium and take advantage of price movement as well. So we're looking for both direction and theta. So that's just the nature of this trade, trading out of the money butterflies. But volatility, let's say first of all that volatility is super impactful, but only for a period of the day. There's a point where volatility no longer has effect on the rate of decay. And that's what we're going to be talking about. There's one point where, let's say, and it's variable, and I'll explain why. There is one point where time becomes the final arbiter, and then it's all up to time. Time is your friend. All right, so let's get going here. First of all, let's check the comments section. It looks like it's doing good. I'm glad you can all hear me. And great. Off we go. So, volatility. How does volatility affect a premium collector? We have essentially I call it 3 different regimes for volatility. We have very low volatility, medium volatility, and high volatility. I actually give it a name because I find it a little bit more descriptive and also a little bit fun. So, and I'll show you where those lines of demarcation are between these various regimes. The reason why we have regimes is because it changes up our strategy, how we go about configuring our trades, and how we perform, how we act, the strategy that we employ. All of that is directly impacted by volatility. And of course, volatility is changing all the time during a day. There's another very interesting thing about volatility. You can have big picture regime volatility, and then you can have localized volatility, and they can both exist at the same time. And volatility is relative to what happened the day before or the hour before. That's another very important characteristic of it, but none of that really has anything to do with what I'm about to talk about. So I prepared a little script, and I'm going to bring that up now. And normally I would be looking right at the monitor, but as you notice, I'm in a different spot today. I'm actually in my control room. Yes, I have a control room. This is actually a studio. And I thought that it would be a little bit more cool. And I don't have my teleprompter, so I have to read off of a script right here, or the notes that I have. So volatility plus premium decay. This is the foundation. So let's start with what volatility really does. When implied volatility rises, options premium expand. And I'm sure you're quite familiar with that. What does that mean? It means that options become more bloated, or they become more valuable when IV goes up. And with it, though, there is another aspect of that. Time decay slows down. And I'm going to show you how that manifests itself. When volatility drops, premium collapses. They also call that volatility crush. And theta ramps up fast. So if you're in a butterfly, say, and you're sitting there inside of the profit tent, and volatility all of a sudden drops, and there are a number of reasons why it might drop, you'll find that the premium, or the value of your butterfly, will start increasing rapidly. Now, there are certain circumstances where we can use that to our advantage with known times when that volatility is going to drop. So what are some known times when volatility drops? Almost on command. All right? Anybody know? Volatility drops. Well, let's say, first of all, volatility tends to rise, and does rise, into uncertainty or unknown events, or an event where the outcome is not known. A good example of that would be earnings or an economic report in the morning. Economic reports are particularly impactful to us because they happen so often, almost every day. So volatility will rise into that event, and then here's the kicker. Regardless of what the event is, volatility will drop after that. And even if the event is like crazy, and that's because now it is known. And believe it or not, the unknown is more volatile than the known. And so if you're riding into an economic report and volatility is rising, you can enter a trade at relatively low cost, and I'll explain why. And then when that event happens, then the volatility drops. If you're in that trade and you're centered, and your butterfly or whatever your premium collection device is, it will start rapidly decaying. And if you're a collector of that premium, in other words, if you're short volatility, that means that your account will go up. So that's a really important, and I'm going to show you exactly why that happens. All right. And, okay, so the second thing, how volatility affects butterflies directly, and that's going to be the lead up to this. I'm going to actually show you an individual option, particularly a weekly option that we use in 0DTE, and then extend that to a butterfly. So what I need to do is bring up a presentation that I have here. All right, that's good. Let's see if I can, no, I couldn't do it on the first time. Never can do it on the first time. And I have so many things open. Here it is. All right, there we go. So what we're looking at here is a time graph and graphing premium or extrinsic value of an option over the life cycle of that option. Let's call this a weekly option, and it has 8 days of life to it. And the vertical columns represent each day of the life of that option. And then you'll see this magenta line that is slowly decaying or retreating at the very top here, and then it's increasing faster and faster and faster until it gets to the last day, the 0 DTE day, where it just falls off a cliff. Just wham! This is exactly the reason why we do 0 DTE, because of this fact. Now, the interesting thing here is that on that last day, you have pretty much 50% of all the extrinsic value, all the premium that was ever available in that option, still available on that last day. And on that last day, we want to collect that. That's our superpower. All right. Now, there are two situations that can happen, or two extremes that can happen, that can disrupt this rate of decay. So this is a particular rate of decay. It starts off slow and then picks up speed and then really goes fast right at the end. Now, one extreme would be high volatility, and the other extreme would be low volatility. Let's think about what happens in high and low volatility and why it would change the rate of decay. In high volatility, we generally associate that with down markets, but more specifically, what happens to price and the action of price. It starts exhibiting greater range. It moves a lot. It goes up and down and all over the place. It's hectic. And so the range of price starts increasing dramatically. So why is that important? Well, let's talk about what options actually are. They are contracts, and these contracts react to a certain amount of time being in the market and an objective of that contract. Just like in car insurance, the objective in a car insurance is to get into an accident, so then you get paid. I mean, we don't hope that we get into an accident, but that's what happens. You get into an accident, you get paid. In an options contract, it's just like a regular insurance contract. In fact, you can think of it as insurance on a price. It has a strike price, and when we go on beyond the strike price, we get paid. If it's a call option and price goes beyond the strike price to the upside, then that option gains value. If it's a put option and price goes below the strike price, then that option gains value. But if it never does that, if it never reaches the strike price, the option does not gain value, at least intrinsic value. And here's the real surprising thing, is that 88% of the time, options never achieve intrinsic value. In other words, they don't end up, the price doesn't end up beyond their strike price. So they end up worthless. That's a very important point, because that's what's going to lead up to the next thing. So that's intrinsic value. There's another type of value that I'm showing you here on the screen in this presentation, and that is extrinsic value. That's the time value. Time value is real, and it's the value that is associated with the option for the time left in that option to achieve intrinsic value. And so at the very beginning, it gives it all the value in the world. It says, yeah, you got plenty of time, and so therefore we are going to puff you up and give you lots of value, extrinsic value, for the chance that you might achieve intrinsic value. So as time goes on and it's not nothing's happening, this time value is slowly decreasing. And then as it gets closer and closer to expiration, it starts realizing, man, we ain't going to get intrinsic value. And so it starts decaying very fast until finally it just goes off, and that's it, done. Well, if there's volatility, let's say a lot of volatility, then, as I said earlier, we're going to have expanded price range, and price is going to go all over the place. When that happens, the market looks at that and says, wow, this price is just going all over the place. There's a greater chance that it's going to achieve its intrinsic value. So therefore, we're going to inflate that premium. And so when we inflate it, I'm going to show you the next chart, what that's going to look like. When we inflate it, that changes that rate of decay. All right, so let's show you that next chart. It inflates that rate of decay. That's the magenta line or purple line above. And you can see it says high volatility rate of decay. Now, when we do that, yes, it inflates it and increases the value of that option. But on that last day, it also increases the amount of premium available that's left to decay or collect. So there's a lot more premium available. The opposite happens in low volatility. Low volatility, we have very small ranging prices. And that has the tendency to suck the power out of that option. And so the option becomes deflated. And so that's what would be represented by this lower line. And in effect, what's happening is that it's increasing that rate of decay. Right? So on the last day, there's much less premium available. That's a huge difference between low volatility and high volatility on that last day. And you're going to see how that manifests itself in a moment on a butterfly. This is an individual option. So that is the foundation of just about everything that we do as zero DTE traders. I mean, there are other things, obviously, and we're definitely in tune to price movement and directionality, but optionality is a huge part of it. I would say that it is at least 60% of our trading. And in fact, most of our trades are the direct result of that optionality. But it's the combination of both optionality and direction to get us into the right spot that sort of multiplies the effect. All right, so this is a single option. If you all understand that, if you don't understand it, I don't know, maybe you can put a note into the comments, and I'll see if I can address that. Looks good. Nobody has any comments? Cool. So everybody understands now why there's a lot more premium available in high volatility, in that high volatility has the effect of delaying decay, and low volatility has the effect of increasing decay. One thing you may note here is that right at the very end here, both of these changes in the rate of decay meet right about there. That's about somewhere between 2 o'clock and 3 o'clock in the afternoon. And it doesn't matter what volatility does after that point. As I said earlier, then, time becomes the final arbiter. All right, so let's get on to what happens in a butterfly. So just keep in mind, high volatility means there's way more premium available. In other words, more profit potential. And low volatility, it means that there's less premium available, less profit potential. All right, let's go to a butterfly. All right, so here in the butterfly, we can see that there's high volatility and low volatility. These are two butterflies that I put on here. They're the same size. They're both put on at the money. And one has the condition of high volatility, one has the condition of low volatility. So in the morning, you'll see that that butterfly and the profit curve in high volatility are very flat. And the butterfly strategy, which the blue line is actually the butterfly's P&L at expiration, you can think of as the purple line as being the exact same strategy, but that's its P&L in real time. And so there's a lot of potential between where it is now in the morning and where it will be in the afternoon when it finally realizes the triangular shape, because that little dome there, that red dome or magenta dome, is going to slowly grow throughout the day until it reaches and morphs into that triangle. But you can see in high volatility, there's a lot of available potential here before that happens. And then the risk, which is from the zero line to the baseline of the butterfly, is very small. So if you have a long butterfly, that would be your debit. All right. Now, the exact opposite's happening in low volatility. So again, remember, high volatility, it decreases or delays decay, and that creates way more potential and way less risk. In low volatility, the exact opposite happens. We have accelerated premium decay, and so on that last day, when you open up that trade, you find that there's way less profit potential, just this tiny little bit above the zero line, and way more risk. Way more risk. All right? That's because of the accelerated decay. It's already decayed. It's all gone. So it's not there available for you to collect. Those are the two most important points in options trading right there. And particularly with 0DTE, and in particular trading butterflies, so that you can neatly change your risk to reward simply by changing the nature of the fly. All right, so there's another aspect to this that is also impactful, and that is the sensitivity to price movement. So let's say that we have a price that's right in the middle, right at the apex of this fly, and we want to move, say, 10 points. I'm going to illustrate that on the next slide. So we want to move 10 points. On the low volatility side, because there's already been a great deal of decay and it's sitting really low, we have a very steep profit curve, P&L curve. And so when we get a 10-point move, we get a huge change in the value of our position because it will go all the way down here, right? In high volatility, it's the exact opposite. Because it's really flat domed, there's lots of potential left. In the morning, there's still a lot left. So in the early parts of the day, on that same 10-point move, there's only a little bit of price sensitivity due to that delayed decay and lots more premium left to collect. So that sensitivity to price is also known as gamma. So there we got it. We have all of these situations. We have high volatility gives us high profit potential, low risk, and low gamma. In low volatility, it gives us less profit potential, high risk, and high gamma. So the way that we adjust for that is by, now there is a rule here in our trading. I mean, this is all very important and all, but what's more important to us is wealth preservation. So when we put on a trade, we're always putting on an asymmetric trade. That means very tiny risk and as much profit as possible. So that means regardless of whether it is in high volatility or low volatility, we're going to maintain that same risk to reward ratio. Now, if we do that, we have to compensate for this reality. And the way we do that is that in high volatility, we put on very large butterflies because there's low risk, high profit potential, and low gamma. We can put it on there and it's no problem. When there's low volatility, we have to do the exact opposite. We have to shrink our butterflies. We still keep the same risk to reward, but we're forced to shrink it in order to compensate for this fact. So that's basically what we do. And I'll show you a chart that we look at every morning. If you've been following my morning market analysis that I used to do live, I stopped it. Friday was my last day last week. I used to do it live every morning and show you an analysis. And the very first thing I would show you is my VIX chart. And on the VIX chart, I have a playbook that describes exactly how we adjust our trades based on this very important lesson that you just learned. So that's what we're going to take a look at next. All right. So we'll go to the VIX chart, and here we are. Here's my VIX chart, and it's literally a playbook. It is showing all these different trades that we can take, the classic out-of-the-money fly, the Batman and time warp, and even the big-ass fly up here. Let's ignore the big-ass fly right now. That'll be subject for another show. On the left-hand side, we have the classic out-of-the-money fly with gauge. And also you'll notice that I'm showing the VIX all marked up into its separate regimes that I talked about at the beginning. You know, there's the low end of volatility below 17 that we call zombie land. There's the mid-range volatility that we call Goldilocks, and we split up Goldilocks into two levels, Goldilocks 1 and 2, you can see down here, because it's a big zone. And then anything above 32, we call that chaos zone. Now, the interesting thing is, chaos zone is still better than zombie land. I'd rather be in chaos than being chased by zombies running through mud, because that's what it feels like. So we use this VIX chart to determine how wide we're going to approach the market with our trades. All based on what you just learned about premium decay and the fact that high volatility, we have less risk, more profit potential, less gamma, and so we can go much wider. And so as the VIX rises up, we go way, way wider. And as the VIX drops, we go much narrower. So that's how we size and give ourselves the best possible chance for returns, for consistent returns, and right size our trades to give ourselves a nominal view of risk. All right, and we'll talk about these other trades. These are edge case trades at some other time, like the Batman and Time Warp. So when we put on a trade every morning, we're putting on, first looking at volatility, deciding how wide we're going to be. And then we do some analysis determining which way we think the market's going to go that day, and some trend analysis, and we choose that. And then the very final thing that we do, which will be another show, potentially this week, where we look at market structure and volume profile. All right. So that's what we're looking at. So every day, and if you, like I said, if you want to go back to some of my old morning market analysis shows, I show this. I determine what width we're going. I look at these charts and I determine what my directional bias is, and then I go over to here to my volume profile. Actually, like over here, volume profile. I mark it up and determine where my structural levels are, and that will help me decide when and where I'm going to get into a trade. All right, let's see here. Anybody have any questions? If you have any questions, put them in the question box, the comment box, and I'd be happy to answer them. So there you go. There's a super impactful. Now I'm going to show you how we might go about this too, and go through a trade so that you understand exactly how we're doing this and why we're doing this. Yesterday I showed you my performance in following this methodology, right sizing a trade, putting it on at the right time, managing it, or putting it on when there's actually an event that will give us the best opportunity, and then managing the trade. Then, of course, the one thing I haven't talked about is what keeps us in the market. What keeps us solvent, right? And that's that asymmetry. Why do we trade the butterfly? We're trading the butterfly for a number of reasons. It's a great tool for letting us define our risk. It allows us to create an asymmetric trade, and then that gives us a big advantage. Now, yesterday I was about to show you that, and so we're going to go back to that right now so you can see, and then we'll tie it all together. All right, so that means that we have to go back to Keynote. There we go. So this is not exactly what I want to show you, but we'll go over this sometime later this week and talk about the different zones and where price might be, how we're going to behave when price gets closer to our fly, etc. So a lot of people might think, man, you're pushing those flies so far out of the money. How do you ever make money? Well, actually, we make about 38% of our profits outside in zone 1. And in zone 0, when it goes against us, we don't make anything because we just let it go. And we make sure that our risk is small enough that we don't have to manage it. So we're only left with profit management, where if you're trading a high probability strategy, I'm sure that you're just trading and managing risk, and you're hoping that you're going to get profit. Your profit's always small, your risk is always large, so you have to manage the risk. With us, it's the exact opposite. Our risk is very small, and our profit is very large, so we have to manage the profit side. We don't have to manage the risk. Risk takes care of itself. So that ends up with two different types of return characteristics or return profiles. And the best way I can describe it is what your returns look like as they're distributed. What is the distribution of your returns in terms of small versus medium versus large returns? Now, if you're a high win rate strategy trader, you might think you're the balls, right? You're the balls because you're just winning all the time, except when you don't, and then you run and hide. Now, the thing about a high win rate strategy is that it has a certain distribution, and if you're familiar with standard statistics, you would know that there's a normal distribution, like I had showed you yesterday. This is a normal distribution of the market where there is an equal amount of moves on the upside of the market and downside of the market. But in trading, it's always very different. In trading, depending on how you set up your trades and what you choose as your strategy, it's going to result in something very different than an equal distribution. It's anything but equal. So in a high win rate strategy where that little U represents 0, the U represents 0, you have a bunch of small wins in a high win rate strategy, right? And you get a bunch of them, and they're good. You like winning a lot, but they're small, and they're capped. They can never grow, right? And then when you lose, you get these huge, huge losers. They can be small, medium, or big ones. And so you end up with a distribution of returns that looks like this. It's called left or negatively skewed distribution. A distribution like this does not scale. Very difficult to scale a high win rate strategy because it means that you have to take the loss side, the risk side, and increase that dramatically. And you're going to have limits to that. The other problem is that when you increase your risk side, you also increase the volatility of your returns. Another better way of saying that is that you're increasing the risk of busting your account every time. Now, opposing that is the other way to trade, the way we trade, the way most pros trade, and that is a right or positively skewed distribution. That means that we only have small losses, and they're capped. We can never lose more than that. And our wins have huge potential upside, sometimes unlimited. And so this is a strategy that can be scaled to virtually any size with very little effort and very little strain on your emotions and your anxiety. The other way, left, negatively skewed, it says it in the name, it's negative, is bad, but that's the way most people trade because they like this high frequency of wins, as opposed to the positively skewed distribution, which is good, the way most pros trade. They can handle a bunch of small losses for the chance of getting very large wins and actually advancing their account. All right, let's see. Do we have anything else in this? No. So here's a big picture of being a loser, and here's a big picture of being a winner. All right, let's go back here. Wow. Yesterday we had a lot of questions. I'm surprised we don't have questions here today. If you like this explanation on premium decay and what it actually means to your trading, why we trade the way we do, why we put on asymmetric trades. I didn't really talk about that in great detail, but we'll put that off to another episode where I'll talk about the principles of asymmetry and how they are lockstep with the idea of capital preservation. In fact, we like to say that our preference is to preserve capital even over making profits. Doesn't mean that we don't want to make profits. It just means that one comes before the other. If you don't preserve your capital, you can't make profits. Also, if you allow yourself to draw down, you effectively kill the one thing that you're truly after over the long term, and that's to compound your results so they go up like this. If you draw down, you're essentially pushing yourself backwards in time. See, one of the principles of drawdown is that first leg of drawdown, of making those small incremental wins, is always the longest leg. That's also the leg that most traders fail. And they fail and they draw down. It's like taking that long leg and then just going back and starting from zero again, or beyond zero. What you want is to be able to continue on in that next leg so that you can then justify increasing your position size so you can continue to the next leg and then increase your position size to the next leg. And then that will give you compounding results. The only way to do that is asymmetric positions. It really is the only way. Maybe cover the gamma wall again next time. Well, gamma wall, I mean, when we talk about gamma, Jerry, it's going to be very, very specific, and there'll be a lot more to talk about. What exactly is a gamma wall? How do we relate it to market conditions? And what does it really mean? And how are we going to use it? We will be getting into gamma wall and gamma trading or gamma strategies a great deal, because that will be one of the strategies that I'll do live here on this show as we get into it. But first I want to give everyone a foundation of what we're doing, and then we'll move into those strategies and start taking those here later in the day. And so hopefully it will be an opportunity for people to learn and make some really good money with very little risk. All right. Maybe cover sigma too. Well, now you may be thinking about sigma in terms of what is our... Now there are two definitions in my book what sigma is. Sigma is like another name for deviations. And so you have, 1 sigma, 2 sigma. That's like saying 1 standard deviation, 2 standard deviations. It's a quicker way of saying that. But we also have strategies that we call like the sigma drift. And so yeah, we'll get into that as well. Is a recording available or not? Oh, of course. This is all on YouTube, so it's always there, right? So you just come back to my channel, and you can go to the live and always watch this. This is also going to be simultaneously recorded on YouTube, X, LinkedIn, and Facebook, and also on Apple Podcasts and Spotify. I think also Amazon Podcasts too. So it's available in a lot of places, and you can go back and watch it over and over again. Probably the best place, I think, is on YouTube. And at some point, I'll also get on Rumble as well. They do have a new streaming outfit, and it's getting better. Now, it's whether or not I can integrate it with this automatically with just a push of a button. Let's see. All great questions. You're welcome, Jerry. All right. So I think that's a lot. That was a lot for today. And we'll leave it there. I don't want to muddy, what we learned here today. Tomorrow, I think I'm going to talk about risk to reward and asymmetry and why we trade small and go after big results, why it's so important. And how you actually prepare yourself mentally to trade that way. It's not the easiest thing. Because first of all, if you've been trading with high win rate strategies, that's what you're expecting. You're expecting to win all the time. And our culture is kind of built around that idea of winning all the time. And so when you get into a strategy that you don't win all the time, well, psychologically, it can burn you. It can wear on you. But when you start realizing the real benefit of it and that those losses don't hurt you at all, that they're tiny, then you can get over that very quickly. Because you realize that now it's not a prediction game, it's a probability game. That we're not sitting here trying to determine where price is going. I mean, we can give it our best shot, but we're still going to be right about 50% of the time, and wrong 50% of the time. We're more interested in positioning ourselves for what is an eventuality. The market erupts in a fairly regular way. It's indeterministic when it's actually going to erupt. We just have to be there when it does. And when it doesn't, we just don't want to lose a lot. That way we end up, instead of big swings in our accounts, we have nice, even sideways motion and then big wins. Sideways, big wins, sideways, big wins. And then that's what will compound your account. And it's all part of everything that we're going to talk about. So tomorrow we'll get into asymmetry and everything that entails. I want to thank everybody very much. Hey, look, if you like this stuff and you think that it's useful, click the like button, share the video with your friends, tell them about the show, have them get on here, and all will be good. Share the show. All right. That's about it for me. Thank you all very much. Coach Ernie is out.